kick off the presentation. So it is on Superannuation Tune Up. So reviewing your super fund and what you need to know about insurances. So first, quick disclaimer, all this information is general information only. Don't go ahead and make changes to your super or insurance and say, hey, Gemma and Phil told me to do this, because we're certainly not doing that. I'm financial advisor at Skye Wealth, and we're licensed to provide financial advice. And Gemma is from Superfears, who also holds a Australian Financial Services license. So don't do anything we say without getting appropriate advice. All right, disclaimers aside. Now, our agenda tonight, what we're going to touch on is we are going to talk about what is superannuation, what actually happens in retirement. So how does it work? Why people should care at any age, not just when you're leading up to retirement. What to look for in a super fund, where to go for superannuation advice, traditional advice versus digital advice, what are the pros and cons. And then we're going to talk about insurance. So what are insurance options inside of super, differences between insurance inside of super and outside, what are the major differences between like retail insurance and group insurance, and we'll touch on some like pricing case studies, so premiums. And then, why is insurance advice important? And then question and answer. So we're going to try and zip through the presentation. We find the most value is really in the question and answers. So at any time, feel free to write in the chat function any questions you've got. And we're allocating a lot of time. So we've allocated an hour and a half here. If we go shorter, we go shorter. We're going to really try hard not to go longer, mainly because I've got to drive for 3.5 hours tonight, and I want to get on the road. So let's kick us off, Gemma.
Okay, perfect. So as Phil was saying, there is such a close tie between insurance and super, and so many things you need to consider. But if we start at the fundamentals on, and it always surprises me, and it shouldn't, but that people don't understand what is super and what actually happens in retirement. And I think if you understand these key fundamentals, then it helps you actually connect and care about it a lot more. So if you think of your superannuation right now, so a lot of times people will go, oh, I hate superannuation, or I'm not a fan of it because my husband's brother's cousin lost all their money in super. But think of superannuation as a tax structure. So it's like a bubble, right? You can invest however you want within your superannuation. You can have a lot of control over that. But essentially, it's a tax-effective structure for us to save for our retirement. It's as if the government went, I don't think these people are going to prioritise saving for their retirement. We're just going to mandate that they have to put money somewhere. So for employees, it's mandated that you have to be saving. Your employer has to put money in to this big bucket saving for retirement. So there are conditions on it. So it's tax effective, yes, but there's conditions on it, which also makes people a bit wary of it. So while it's tax concessionally and it's favourable in that sense, it also has restrictions on when we can access it. So for majority of the viewers today, that preservation age, the time in which you can access it and start using your super, is going to be 60. So if you're born after 1964, it'll be 60. If you're before that, it's tiered and it drops down to 55, and you can find that out on the ATO website. So yes, it's really tax effective. It is preserved, which means majority of the time we can't get our mitts on it, and it means that we're actually saving for retirement. But I find the easiest way to think of superannuation is think of it like right now it's a big bucket, and that bucket is filling up with contributions, compounding interest, returns. So it's a bucket at the moment, but when you get to retirement, imagine just adding a tap to that. So the tap turns on, and perhaps every fortnight or every month you draw a regular income out of it that then funds your living expenses. So right now you might be being paid fortnightly or monthly. Turning the tap on this big bucket of money means that you now have regular income in retirement, meaning that you can fund all your living expenses. And a lot of the time that will be, yep, you've got a regular income coming in retirement that you live off, but you might need a new car or a new holiday, and you can still dip into the bucket and get those lump sums. So yeah, the concept of it's going to fund your retirement, how that actually works is pretty simple. Think of it as a bucket, it's going to turn into a tap. So why should people care about superannuation? So right now, a lot of people are like, super boring. I'll care about it when I retire. But there's actually things that you can be doing about it with it now that help your lifestyle right now as you're accumulating your wealth and other things are going on. So the most important thing to remember is superannuation is actually your money. It's not free money. It's part of your salary. You actually have to work to earn this. It's your wealth. It's not part of a government scheme. It's literally your money. Like if I was knocking on your door each fortnight and saying, hey, give me 11% of your pay, you'd be going, why? What are you doing with it? Where's it going? So this is literally money coming out of your pay to be put into something for your retirement. So you need to care about it. The things that you can be doing right now, why it helps you now and also in retirement, is a few different reasons. So one, right now, it's one of the most tax effective ways that you can invest. So if you've got super, you're already an investor, right? So you can tax effectively invest and have a lot of control over there, so you can reduce your taxable income. You can help cash flow insurance premiums, which we're going to get into later. But, like right now, we're all worried about our mortgage payments going up and the cost of groceries and all these kind of things. But super is something that can be funding really, really important insurance in your life as well. And a lot of people don't realize that super can also help you save for your first home. So there's things like this first home super saver scheme, terrible name, but it's there. And it's a tax effective way that you can save for a deposit for your house. So super is not just this snoozy thing that you need to think of when you're 60 plus. There are absolutely things that you can be doing right now that are going to help you build wealth for today, but also, help you out for retirement. So what to look for in a super fund, and this is probably one of the main questions that I get from people is, okay, cool, well, I know super is important, but what do I actually do? What do I look for? And what are the most important things that you should be considering? So in Australia, there's hundreds of different super funds, and they are starting to close or consolidate. So I really do feel like it's going to get easier in the future. But right now, like if you've been working for a while, you might find that you've got several super funds because every time you started a new job, you automatically got a new fund. So you might have a few out there and you're thinking, well, how do I actually choose between the super funds that I have or the others that are out there, and what options do I have? So I think there's three key things that I would consider or recommend you consider. And then there's a fourth, of course. So we'll go through that as well. So when you're looking for a super fund, whether it's a brand new one or consolidating on the ones that you've got, fees is really, really important. And it's not the cheapest is the best. It's absolutely not. But fees mean that you're keeping hard-earned money in your pocket. So the higher the fees, the more you're going to pay, the more outgoings you're going to have, which is going to affect your returns, the contributions that you've had, and the performance. So fees is really, really important. So keeping them as low as possible within reason is really, really important. Performance is so important, but it's absolutely not guaranteed. So this is a tricky one. So I absolutely believe that performance is important, but it also comes with a huge disclaimer that past performance isn't an indication of future performance, okay? And that confuses everyone because they're like, well, why do you even mention it? But when I talk about performance and when other professionals do, what you want to be considering is we don't actually care who was the best, shiniest super fund in the last 12 months or even 5 years. When we talk about performance, we're looking at a long-term performance history, them consistently performing. Yes, they're going to be bad years, but in different market cycles, meeting a benchmark, doing what they say they're going to do. So really what we're doing when we're looking at performance is not the best return in the last year and, having that high five at a barbecue that your super fund was the best in 12 months. It's more about, well, is it consistently performing in different markets? And if it's consistently underperforming, then getting out of there. We now have the reports that come out every single year that look at performance for super funds. So you might actually be getting a letter in the mail from your fund. It's like the naughty list, right? And they're going, hey, we underperformed. We're a pretty bad super fund, but hey, please stay with us. If you're getting those letters, you should absolutely be taking performance into consideration when you're looking at a fund. So fees is important. Performance is important if you're looking at a long term, so 10 years plus when you're sort of been through different market cycles. And then the third one is insurance. So insurance is so important. We're going to jump into it a bit later. but a lot of Australians have insurance within their superannuation. A lot of people actually don't realise that they're paying for it. But what you want to make sure is, if you're paying for insurance out of your retirement savings, one, it's a cover that you need, that you're prepared to pay for. You're not paying for something that you don't need. So you never want to be overinsured, paying for something you don't need, but you don't want to be underinsured, that if the worst happens, that you can't fund your core living expenses and things now. So finding a super fund that actually has the insurance that suits your occupation, your lifestyle, the amount of cover that you need is really, really important. And I think probably in this space, it's the biggest misconception. I feel like as advisors, we're undoing a lot of work where Australia's just been told, consolidate your super, you should never have more than one super, click here, consolidate, one fund is the best, otherwise you'll be paying multiple fees. But I actually think, you can be really strategic with your super. If there's a super fund that ticks all the boxes for your insurance needs, or perhaps that's your only option, but it's not the best for your investments because fees and performance don't align with that, then having more than one super fund is actually a really solid strategy. So it's not just head in the sand, I couldn't be bothered sorting it all out. You can be really strategic about it, and perhaps you have more than one super fund because one fund can't tick all these boxes for you. So insurance, understanding what you need in insurance and where you can get it from people like Skye Wealth is really, really important. And then the fourth one, which is pretty new, is your ability to invest within really your values. So within most super funds, the super fund is like the administrator. So imagine going to Coles. Your super fund is pretty much like Coles. You walk in, but you can pick lots of different products and lots of different brands. That's generally how super funds operate. So the super fund itself is like the administrator. They're doing all the paperwork. They're giving you different options. But the actual investments that you invest within that fund can be a range of different things. So you're not investing within that actual fund. You're going to their menu and going, oh, well, I want this investment, or I want high growth. So making sure that whichever super fund is the administrator of your money and your contributions, that you can invest how you want. So if ethical investing is really, really important to you, then finding a fund that aligns with that value is important. If that's not a priority right now, then finding a fund that is low cost, has performance, and ticks all the other boxes is where you want to sit. But I think they're the four main things that you need to consider when you're looking for what super fund is going to be right for you. Actually, on that point as well, another conversation or question that often comes up is, how often should I be reviewing my superannuation? So this is a tricky one, but I would say that for the people that are interested in this, every single year you should be taking an interest in your super. When you get your statement, you should be checking, have my contributions gone in? Is my insurance where I thought it was? Is my beneficiary up to date? And are my contact details right? So they're the things you should be looking at every single year. But if you're actually looking at, well, should I be changing because of fees and insurance and things like that? I don't actually think, and other advisors might disagree, but I don't actually think it's something you want to change all that often, because it is expensive to change in and out of super funds. I think that if you're considering whether I should change a super fund, you should be doing it because you're unsure about the super fund, maybe their performance, or you got that naughty letter saying, hey, we haven't performed and sorry, we let you down. Or you've had a major life change, like you've just got married, you've bought a house, you've done different things. So I think major life events is when you want to review your super. But if it's just every single year and you're pretty comfortable with how things are, you don't have to compare the market on everything. You just need to know, well, that super fund suits my needs, but yes, all these other things, my address, my contact details, my contributions are going in. So, okay, so where do you actually go when you want to get advice on superannuation? So if you want to learn about superannuation and you want to take that next step, what actually happens? So other than attending webinars like this, which hopefully answer a lot of your questions, these days there's actually lots of different ways that you can get advice. So previously, a few years ago, we literally only had a traditional advice model, which was you would see a financial advisor, you would pay for advice to get a statement of advice, And they would usually look at a heap of things at the same time. So Phil and I, this is where we originate as financial advisors. You'd holistically look at super investments and their insurance, everything. Whereas these days, so that traditional model absolutely still exists, but every year they release like data on kind of, well, what do you pay for that kind of service? And it's usually 3.5 to 5 kind of grand minimum. But that's great if you're in that position and you can afford that and you're wanting really to take that comprehensive step. The other option is you can go directly to your super fund. Now, a lot of super funds, not all, but they will have in-house advisors or intra-fund advice. The issue here with this is they're likely not going to say, hey, another super fund's better for you. They're more likely going to help you fix things that are going on within that fund. So maybe help you with your investment options that they offer, or contributions, or a beneficiary. But imagine walking into Ford and them saying, oh, actually, after what you've told me, a Corolla is better for you. Like, it's not going to happen, right? They're going to recommend the product that they have. So super fund advice is great if you already know that super fund is great for you, but then probably not going to recommend you go elsewhere. The other option is DIY. So for those of you that are really into researching and you're great to get into the detail and you want to understand about a fund's performance and investment options and returns, and you will make that decision yourself, you can absolutely do that. And there's lots of resources out there to help. There's sites like CanStar and different places, but you've just got to think, are they taking into account all of the options out there? So far we've got traditional financial advice, we've got direct from your super fund, doing it yourself, and more recently we've got places like digital advice, which is what SuperFierce does. It's absolutely not for everybody, but it fits in a gap. If you don't fit into one of these molds that we've already talked about, then digital advice might be for you. So this is kind of like, it's also referred to as robo-advice, but it's where an algorithm rather than a person is actually making that assessment for you based on a specific need. So you couldn't go to robo-advice or digital advice and put in all your specific needs, but you can, it's if a specific thing suits you, like I really want to focus on fees or I really want to focus on performance. So this is where you need to tailor the approach to what model suits you best. So SuperFierce is a digital advice platform. They have a full AFSL and they provide advice looking at superannuation solutions for you if your focus is low cost. But they can't provide, so the reason that you pay 3.5 grand minimum for an advisor, whereas digital advice you might pay $50 to $100 for, but it doesn't suit everybody. And then the digital advice, we're then going to go, well, we couldn't actually help you with insurance. So people like Skye Wealth will step in, and all these pieces of the financial planning puzzle can come together, but you've got to do a bit more work. Whereas if you walked into a financial advisor's office, you're going to pay more, but they're going to look at all of it for you. So it just depends on which stage and what things are important to you and where you fit in the model. But there's so many options, and that's the key. So instead of head in the sand, I don't want to do anything right now because I can't afford the traditional advice model, there are so many other steps that you can take in this puzzle to your financial freedom that you can be taking today that suit your budget and what you're looking for. So Phil, I'll hand it over to you for what options there are for superannuation and insurance.
Well, I mean, everyone who's watching, feel free to write. Excuse me. Feel free to ask any questions. I literally wrote down 4 questions I'm going to ask Gemma at the end, and I know most of this stuff because I've been advising for plenty of time. So if I've got questions,
and see if I know.
So we're going to talk about the insurance options within super. So what are the options within super? So superannuation has some limitations, and we'll touch on that. But the 3 options for insurance within super is life insurance or death insurance. Some super funds will call it death cover. It's really just a lump sum payment if you pass away or if you're terminally ill. And that'll get paid out to either your estate or the nominated beneficiaries. Second one is total permanent disability, or TPD, or disability. And what that is a lump sum payment if you're unable to work due to if you're totally and permanently disabled and unable to work again. And so, there may be some length of time out of the workforce that you need to qualify for, and you need doctors to sign off saying, hey, you're unlikely to ever return to work again. And the third one is income protection, or salary continuance is sometimes what it's called. And that is a monthly payment that will replace a portion of your income if you can't work because of illness, injury, sickness. And so there's waiting periods, normally 30 or 90-day waiting periods. And so that's the time at which you're injured. You need to wait that period of time. Sometimes it can be as long as 2-year waiting period. And then there's a benefit period. How long will you get paid for? So most super funds will do like a 2-year benefit period. That's most common. Some will offer 5 years, and some will offer till age 65. So that's just the core insurance cover that is offered through super. Now, the differences between insurance inside of super versus insurance outside of super, and we'll talk about like goods and bads, because none of it's all good, none of it's all bad. And so the good thing about insurance outside of super is inside of super, the good thing about it is it has less impact on your personal cash flow. As Gemma mentioned, your super money is your money, so it's still accessing your money, but it's not accessing your day-to-day cash flow. So you can be paying your annual premiums via your super fund. The other thing, it can be cost effective on default amounts of cover. So I'll talk about premiums and show you some comparisons on that. Generally speaking, like the default level of cover you get when joining the fund can be cost effective. But the bad thing about the downside sometimes is that it can be more expensive when you increase the cover, which I'll go through. The default level of cover within super, it's good because you get it when you join the fund. But it can be limited. So the good thing about it is it's got limited or no underwriting. So, any pre-existing health issues will still be covered under the policy. And the downside is the default level of cover is quite low. Now, the bad thing about insurance within super is claiming can be difficult. So, there can be extra tax on things like total permanent disability. You do actually get a tax deducted from that payment if you're pulling it out of super, but it can be tax effective when paying the premiums. The good thing about policies outside of super is it can be super linked to your super policy. So if you set it up through a financial advisor, you can link the policies with policies paid through super and outside. Group policies or superannuation policies, one of the bad things about it is the terms and conditions there are a lot of limitations with those group policies. And the big thing is there is no trauma cover. So trauma cover, I didn't explain what it is because it's not offered through super funds, but it is for serious medical events. So things like cancers, things like heart attacks, strokes, that'll pay a lump sum payment. So similar to a TPD payment, except it's for specific medical events. Cancers being a key one that's paid out on. If you have cancer and you can still return to work sometime in the future, well, you may not get a TPD payment, you may not get a life insurance payment because you're not terminally ill, and you may just get your income protection. But trauma covers that lump sum cover. So why not both? Now go, Gemma. I need you to say it in Spanish. Let's go. You're on mute.
My friends will say that I'm saying this wrong because I learned it off the taco ad, but it's ¿Por qué no los dos?
Perfect. It sounded perfect to me, but I can't speak any Spanish. So why not both? Now, when you're setting up insurance through a financial advisor, and sure, you're saying this because you're an advisor. No, it's because there are limitations. Super funds will only offer you the products they can offer when you're going to their advisors. And if you're going to an insurance company direct, they often don't let you split the cover and pay for some of it through super. So, and it's really called retail insurance versus group insurance. So I'm going to spend a little bit of time talking about the comparisons between the two. But the good thing about retail cover is you can actually have the best of both worlds. You can have it where some of it's funded through your super fund, but some of it's not. So you're not getting the limitations on the T's and C's of the policy. So what are the major differences between those two? So I'll just touch on group insurance versus retail insurance. So group insurance is when you go to your super fund and you set up insurance through that super fund, they have one insurance provider. And they will tender that contract around every few years, and they may move it from insurance providers, but they only have one to choose from. So if you want to increase your cover, you've got to increase it with their insurance provider. When you're setting it up with an advisor, we can shop it around to any insurance provider on the market, and so there's just more flexibility in who you want your insurance provider to be. Now, the other thing about group versus retail insurance is the payment flexibility. And this is actually one of the biggest pros towards setting up insurance with an advisor, is that you do get that payment flexibility where you can link the policy. So some of your premiums can be funded through your super fund and paid for by your super fund, and some of the policies can be funded outside and paid personally. And so you can have the best of both worlds with that. And the other thing is the group insurance cover, those policies can change over time. So your super fund, whoever it is, will have an insurance contract with an insurance company, and then every 3 years or 5 years, they'll tender that contract around. And the insurance companies who are bidding for that group insurance contract will come and negotiate with the super fund and say, hey, how about we remove A, B, and C from the contract, and therefore we'll save your members money. And the superannuation trustee will make that judgment call, what they think is in the best interest for all their members. And they've always on walking that tightrope between making sure premiums are affordable, but also getting good relevant cover for their members. And the cost. So the cost of insurance, it is complicated, and I will touch on it, but the cost within group insurance, it is all grouped together and then distributed to all members. Retail insurance is all individualized. So one of the best options, and this is why we like working with Superfierce and Superfierce like working with us, is because we kind of complement each other when you're using kind of an advisor to set up your insurance policy, because the group insurance cover, as I said, you've only got one insurance company to go with. Whoever the trustee or whoever the super fund is, that's who the insurance provider will have to go with. So if you're with Australian Super, their insurance provider is TAO. If you're with Australian Retirement Trust, their insurance provider is AIA. Now, if you're with Australian Retirement Trust and you want to go with TAO, you can't do it directly with Australian Retirement Trust. You have to go through a financial advisor for that. So a financial advisor, we can set it up where the insurance provider can be with any insurer, and the insurance company they'll set up a super fund on your behalf, and they'll just deduct those premiums from your super fund. And the benefit of that is really if you move super funds in the future. So this group insurance option is you're with super fund A, you decide, hey, I want to move to super fund B, you have to move your insurance all across. But with a retail insurance option, if you have it outside of your super fund but paid for by your super fund, then you can have your insurance provider you just sign a new form to say, when you move from super fund A to super fund B, you just sign a new form to say, hey, get super fund B to pay these premiums now. So you're not moving insurance providers over time, which is may not sound that big a deal. How hard is it just to do a new application? It is when you have pre-existing health conditions. So if you've had a back issue, or if you've gone on a mental health care plan recently, and then you move super funds and your insurance is through that, they may have underlying conditions on that policy that says any pre-existing condition will be excluded. Or if you go and increase the cover and you want more cover, then that's where you come into a bit of an issue with regards to potentially having exclusions now on your policy. So the policies can change. So this is a group insurance provider. So on 1 May 2023, what happened with, I don't know if we're saying the super fund, but it's Aware Super, fun fact. Aware Super, what they did is they said, before 1 May 2023, they said if you are on income protection claim and then you're eligible for a disability claim, we'll pay out on both. Now, moving forward from 1 May 2023 onwards, now they're saying if you're receiving an income protection claim and you're getting your monthly payment, and then after a year, you apply for that disability portion of the insurance, so that lump sum cover. As soon as we assess you to be eligible for that TPD claim, we'll pay you that lump sum, except we're going to stop the income protection. So we're going to stop that income monthly benefit. So if you've got a monthly benefit till age 65, you almost don't want to claim on your TPD cover, because if you're totally permanently disabled, you're going to get your monthly ongoing payments. Well, you don't want to claim on that lump sum cover. So
and this is where you need an advisor, right? Like to help you work out, well, A and B could happen, which is going to be the better way. There was another fund that did this recently with their TPD, which is supposed to be a lump sum payment, a one-off, and they changed it to whatever your cover is, we're dividing it by 5, and you need to reapply every single year to see if you're still eligible for the next payment. And TPD is like a lump sum. So this kind of stuff's changing is pretty concerning.
And that's kind of that's the game with group insurance cover. It's you don't own the contract, the super fund does, and they're incentivized to make the premiums as cheap as possible. So they're going to make these judgment calls with TAO. So Aware has got a contract with TAO that they renewed, and they wanted to make these changes to mitigate those premium increases. Now with
Which
the
helps
retail,
it helps the masses of their members pay less, but it's the people that have to claim that are then disadvantaged. So
that's right. Yeah, it's
literally trying to do what's in the best interest for the majority of members, not the people that are going to go and claim.
Yeah, and like I don't love it. I geek out on insurance all day long, and we help people claim on their insurance. So I obviously don't love it. But it's not like they're aware of being dodgy or bad because of it. It is just what they have to do to help manage their members' money, because they're making these judgment calls. Now, with retail insurance, the insurance provider can't change the contract on you. So it's guaranteed renewable. Whatever you sign up for, even if the policies can no longer be sold anymore. So some of the old policies like I've got for income protection, you can't get that anymore today. And so, but the insurance provider can never change that contract. So you've just got certainty to know that what I signed up for, if I claim in 10, 20, 30 years time, I'm going to get paid out on the same conditions that I signed up for. But group cover, you don't have that certainty. And when it comes to insurance, you kind of want, in my mind, you want certainty. So cost. Now, cost is complicated. Now, cost with like super is fairly straightforward. What fund are you with? How much money do you have invested? It's, there's percentage fees and, fixed fees. When it comes to insurance, there's so many factors that come into cost. So your work, are you male or female, how old you are, do you have any family history of any condition? So it is complicated, but just out of the interest of trying to give as much info as possible, we're doing a premium comparison. Now, we've picked 3 of the top super funds in Australia, which is Australian Super, Aware, and Australian Retirement Trust. They're the 3 biggest public super funds. And Host Plus is the 3rd because, Barefoot Investor loves Host Plus, and it's generally a fan favorite. Because the fees at one point in time were the lowest. So a lot of people moved to Host Plus after reading Barefoot Investor. So, just based on, we've got this graph here, it can look a bit complicated, but this top line up here is the default level of cover. And I've shown the premiums versus what Australian Super charge versus what the underlying insurance provider charges their premiums if you go through a financial advisor. So Australian Super, if you go to their default level of cover, which is $178,000 of life insurance, $51,000 of TPD cover, and $3,000 per month of income protection for a 36-year-old female radiographer on 80 grand a year, then you're going to pay less if you go through Australian Super. But if that same person wanted to increase the cover and said, look, I want $1 million of life and TPD, I also want income protection that lasts till age 65, because if I can never work again, 2 years of $3 grand a month is probably not going to be that much. With a kicker of 51 grand, the technical term we use at Skye is you're going to be financially stuffed. if that's the case. So, you may want to increase your cover. Now, we've done a premium comparison for this client where we've increased it through an advisor with TAO, and it's $1,621 per year for that cover, versus going to Australian Super and increasing the cover, and you're paying $2,770 a year. So it's much more expensive when you increase that cover. And this is pretty it's definitely not all the time and for everyone. Don't go away thinking that this is going to be the case for everyone, but it's the same with Australian Retirement Trust. So we've got a 46-year-old, office worker, 95 grand a year. Same, looking at the default cover premiums versus increasing the cover. Again, AIA is the underlying insurance provider for Australian Retirement Trust, and it's actually cheaper to go to an advisor, even on the default level of cover for this scenario. And then when you increase the cover again, it's still on a percentage increase basis, it's still a lower percentage increase and a lower dollar figure. You're saving $1,000 a year going through a financial advisor with this. And one thing to note for this particular client, AIA was not the cheapest insurance provider on the market for this when we did the comparison report. So, we may or may not be recommending AIA at that point in time for that client, but then they actually weren't even the cheapest. So there were others that were cheaper. Same, Aware Super, female, OT, 110K a year, 43 years old. Looking at the default level of cover through TAO, through an advisor, it's cheaper than going through Aware Super. And then when you increase it, again, it actually on a percentage increase, didn't increase that on a percentage much greater going through Aware, but as a dollar factor, it's still cheaper going through a financial advisor for this client if you want $1 million of life TBD income protection. And when we haven't even factored in trauma insurance cover as well. Same for host.
And we haven't factored in also all the extra bells and whistles that you get outside of outside of superannuation, and the less hurdles that you have to go through at claim time. Because if you claim on superannuation insurance, you're claiming to the insurer, like your example, MetLife or AIA. But then when the money is actually paid, it's paid to the super fund, and then you got to apply to the super fund and jump through some hurdles proving that you can actually get it out. So yes, it's cost effective in a lot of circumstances, but there's also so many other benefits of having it structured properly through an advisor.
Yeah, I mean, and we're trying to simplify things, and premiums is always the reason why I land on premiums a lot is because a lot of people, a lot of Australians have been told for many, many years that super funds offer the cheapest insurance product, because they insure millions of members. So of course they can go to an insurance company and get the lowest and cheapest price. But the reality is that's just not the case. Claims experiences within those super funds is showing that it's not the case for them. And that's why we can talk about bells and whistles, and I love talking about that when we talk to our clients. But on the whole, let's just break it down and look at the cost. One of the biggest myths I find is that insurance through an advisor is going to be so much more expensive than a super fund. And that's kind of why I'm just trying to show the three biggest super funds and Host Plus, which is probably the most popular super fund. When you break down the actual premiums, and because these products aren't the same, the products through the advisor is actually better on the comparison, but I haven't even touched on any of that stuff. But when you just look at a premium factor, almost like anecdotally, and we've got the numbers internally, I think it's something like 80 or 90% of the times it's cheaper to get the products through the advisor than increasing through the super fund, because we always do that work, that body of work in our business.
I think people need to know that super funds are really, really good at super and managing super, but insurance is just their tick box that, we have to offer this. It doesn't mean that they're great at picking what's going to be best for members or most cost effective. Yeah,
exactly. And legally they have to have insurance. Like that's a big part of the reason they have it. Is not because they want to be in that business, because they're not in the business of insurance. They just outsource that work to an insurance company. So why advice on insurance is important? Well, I've just kind of run through, just from a premium point of view, advice on insurance is super important, because you may have been told on a Facebook comment or whatever that, go to your super fund, it's cheaper, it's better. But just from a premium point of view, it may not be. So Now, I've gone through and talked about why I personally don't love insurance within super. However, when we go back to our own stats internally in our business, Skye, we made 154 recommendations last quarter, so January to April. And out of that 154, 78% or 78 of those clients, actually, we told them to keep their existing cover through their super fund or make an alteration to it. So even though it's, we don't love it, don't go out there and just go, oh, I'm going to trash my insurance within my super fund and I'm going to roll over to, ABC super fund. That insurance is super, super important to consider as a part of your overall insurance needs. And so, 40 of those clients, we told them to replace that cover. So we actually told people to keep it more than we told them to replace it, which is really interesting because a lot of people think, well, I'm going to an advisor, they're just going to move me to an insurance product that's going to pay them more money. We get paid from insurance providers, yes, but we look at your overall insurance needs and a big thing for us is to make sure you're how do we put you in a position that if you ever need to claim, and that's going to be a horrible situation, you're most likely to get a claim. And so that's why we do love that default cover. We just don't love it as the only option to consider. And so over to you, Gemma, but if you can kind of wrap us up with your own experience.
Really good lead in. So I have a very close to home example on why default insurance is important, but it shouldn't be your only avenue. So my ex-husband, he had insurance within superannuation funds. So we had found a couple of insurance policies, superannuation policies from when he was 18, working some random jobs. And he had already started having some back issues and some chronic pain and things when I'd met him in our early 20s. And being an advisor, I thought we need the best cover. We need to go this. We need to get, insurance outside, link it to super. And he got rejected for every insurance because it's, I don't know, Phil, you'll be able to say to this, but I find that it's kind of like 3 strikes and you're out. If they have to exclude more than a certain amount of things, they just can't generally offer a policy. And he had a few too many medical things going on that he could get cover. So I had found these random superannuation policy, like super funds with a couple of $1,000s in it or whatever. So strategically, I decided that we would just keep money going into.
You did all the life admin. It was you.
Yeah, I know.
That's pretty common. One person does the life admin. Yeah.
I love that I gave him credit for it, but
yeah.
I decided that, you know what, we'll just keep them ticking along because you can't get any other cover. They're not great. They're not actually what you want, but you can't get anything else and it's better than nothing. And really surprisingly, it happened much quicker than we thought. At 38, he was deemed by his specialist that he would never work again. He was a builder. He can work and he does have the ability to retrain and do different things, but in the job and all the experience that he had, and with he's got back problems and movement and his spine's fusing. So all the specialists were like, you need to stop what you're doing now, otherwise you're going to have no quality of life, preserve the movement that you've got. And I always say to people, because people feel really guilty on claiming on personal insurance, like it's a thing, like calling in sick, you really have to justify that you're on death's bed, right? But it's just like if you scratched your car or you hit a pole, you wouldn't have any hesitation on calling the insurance company and being like, hey, I pay for car insurance, can you fix it? And personal insurance is exactly the same. So he had been paying premiums in his superannuation. We had 2 policies that we kept going with 2 different super funds. And at 38, he claimed on both of those and stopped working. So he had 3 months off work. 2 specialists signed off that he needs to stop work because his ability to have any kind of life outside work is rapidly declining. And now he won't ever work again, but he had an insurance policy that he has kept in superannuation. He draws an income out of it. So you might decide if that insurance money comes in for you that you take it all out and you pay some tax and you pay off your mortgage or whatever. But options are there now available for him to draw an income out of it, take it out if he needs to. But most people can't imagine like a 38-year-old fit tradie actually claiming on insurance and not having like a life-altering disability. he still surfs, he still travels, he goes camping, he does all the things that he wants to do, and he can still maintain that lifestyle that he's accustomed to because he had personal insurance. Whereas I find a lot of people say, I don't need insurance, I'm healthy, that won't happen to me. You literally don't know what's going to happen to you. And chances are, if it does, your life's not going to stop. Your personality and the things that bring you joy and what you love doing isn't going to stop. So having your income protected or a lump sum for this means that you can still do all the things you love and pay for your extra medical treatment. But generally, unless you pass away and you're getting life insurance, your life and your expenses don't stop. They just become a burden on someone else if you weren't adequately protected.
Yeah. We try not to give the hard sell on these webinars about insurance. So good job, Gemma, for making everyone feel bad if they don't have it. But I agree. We us and the advisors in the team, we sometimes look at people who at the end of the day, we try and educate people, empower them to make an informed decision. If they decide not to, then it's totally up to them. I don't pay their premium. Yeah. But sometimes we're just like,
but hearing these stories, we just want to shake them, right? And until I had the personal story that I can go, you should see, and so he's my ex-husband, we're still close. He gives me permission to tell this story. If I see him at the pub, he's telling everyone that will listen that they need personal insurance. And he does the spiel that I do now because he's heard it so many times. He's like, if you had car insurance, you would definitely claim, and you're your biggest asset. And I'm just like so proud. But yeah, it's just mind blowing to me. But I understand that people think they're invincible, and they hear stories and they think that's the extreme version, but they don't hear the softer versions that people still are living their exact same life, but now they don't have an income. So this is why insurance is so important.
Yeah, I agree. So we're going to move on to Q&A. So we've got some questions that have come through Instagram. Now, look, I would love to pretend I know anything about how we've asked these questions on Instagram, but I don't. So we've asked them on Instagram. Somehow, magically, they came in. But the first question is, if you obtain insurance outside of super, can you pay through fees through your super fund? So the answer is yes. And that's kind of the biggest message I want to spread is the fact that you can choose the insurance provider that best suits you, and your super fund that best suits you can pay a lot of those premiums. Now, the only downside is you do need a financial advisor to do that. You can't go to your super and say, hey, can you get me insurance with ABC insurance company and still pay for it? They won't allow that. And most direct, or I think still all direct insurance sales won't allow you to structure it through super. So you do have to go through a financial advisor to structure it. But that's the best way to do it anyway, and should be doing it. But I'm a bit biased in saying that.
No, I 100% agree. Get the professionals who know what they're doing and can be really strategic for you, and it's going to cost you less and get you a better outcome in the long run.
All right, next question is, Gemma, do you want to answer this one?
Okay, so the question is it sufficient just to have insurance through superannuation? So this is a really hard one because it depends on your situation. Some people don't need insurance and other people do. I think that having insurance, default insurance through your super for majority of people is probably better than nothing. But I don't think it's sufficient. I think you need to really dive into that a bit deeper and work out, well, what do I need? Because yes, having insurance in super is great, but you also don't want to pay for something that you don't actually need. So regardless, it can't be head in the sand and a tick box. Yep, I saw it on my statement. It's all good. I think you need advice regardless. But even when you go to someone like Skye Wealth and you get superannuation and insurance advice, I would hope that you then have a roadmap that goes, well, it's not like I'm 30 and I'm going to be paying these premiums till I'm 60. The roadmap should be, well, as you build wealth and you build other assets and you pay down your debt, at what stage can we be cutting back these premiums, shaving off the cover so you're not paying for something that you don't need? But yeah, regardless, I don't think it's sufficient. I think it depends on your need, but you actually need to look at it and make sure it's for you, because the super funds are going for your age, this is what you should have. And they don't know you, they don't know your situation.
Yeah, and so to touch on that as well, like the downside of those insurance policies is they can change on you, and you get a significant notice letter.
Yeah, so not only the terms change on them, but as your age bracket changes, so you might have a really high amount because they think, oh, the majority of people have a higher income or like a high mortgage at this stage, but you might be doing things on your financial roadmap at different stages, and the default cover that's changing might not align with where you're at in your financial journey. So it's not good enough just to go, my super fund's looking after me. Think of your super fund as really great, hopefully really great as your super provider, but you need to really look at that insurance yourself.
Yeah, and I mean, I spoke to a lady the other day. Unfortunately, she went and read Barefoot Investor and read, reduce all fees in super, and heard that as, well, cancel insurance premiums because that's a fee, and I can see how much it's costing me, and cancelled it. And then 2 years later, had cancer and had a claimable event, and would have been on claim for multiple years because she was out of work. And so, don't go and cancel it and move super.
Yeah.
And we'll kind of touch on that a little bit. But Gemma, questions for you, I think. 27 years old. I've never put much thought into it now. I started working full-time at the start of the year, finished uni end of last year. How do I pick a better fund? Is it literally just looking at who's got the highest per annum returns and the least fees, or is there more to it?
Yeah, so there's absolutely more to it. Like we touched on, I think fees, performance, and insurance are your main priorities. But then looking at, if there's other things that are important to you, like ethical investing or something. But this is where companies like Superfierce, who I work for, really, really provide, can fill that gap when you don't know where to go. So there's lots of online comparison tools. That's not Superfierce. They're actually an advice company that you put in your details and it'll say, so if you're looking for the lowest cost for your projected balance and how to invest within that fund, so which investments do you actually pick within that fund that are right for your age and your time to retirement. So super funds will give you a menu. But a lot of the time, if you just went, oh, right, well, I want high risk or high growth or whatever, that might actually be the most expensive option that they have. Whereas when you come to a company like Superfierce, we go, for you, what's the lowest cost? Has it performed? And then when you get to that super fund, which investments or which mix of investments do you pick that suits your age and your time to retire? So if you're not sure, I would absolutely recommend getting advice. And a great way to start that's going to be low cost is a company like Superfierce. So you can go superfierce.com. You can even just use their free retirement planner to see if you're on track. If you want to DIY it, there's quite a bit to it. And if you're going to focus on returns, just make sure it's a 10-year plus period. We don't care who was the best last year because it doesn't tell us a lot, long term.
Well, that was my question I wrote down. I told everyone I did write down questions, and it's true.
You wrote down 4, right?
Yeah, well, 3.5. I've got a sub question, so it may only end up being 3. So, when we get those underperforming letters, do we just go and change super funds then?
So, if an underperforming letter has come to you, it's generally alarm bells, right? They're not sending them to the ones that have just had a bad year. They're constantly underperforming. The letters that I've seen go out, the targeted funds there generally, and this is much a generalization, are also expensive because they're old school super funds, right? So you'd absolutely need to pay attention if you get that letter. You can then do some research and do some looking around and get advice and plan to stay with that fund. That's totally fine. But you don't put your head in the sand and go, oh, they just had a bad year. We've all had a bad year. You actually look at it. If they've been told by the government that they have to write to you, you want to look at it. And a lot of these funds, I think, a lot of funds are closing down on merging because it's getting harder and harder to work in this space. So over the next few years, I can totally imagine that more and more funds will consolidate. So in the last couple of years, we've seen really, really big, strong performing, great funds like Q Super and Sun Super merge. And they're all going to join forces because this is a really hard space to provide a lot of value in. So you might not get an underperforming letter, but you might get a letter saying, hey, we're merging or we're doing this, or you need to pay attention to these things.
Yeah. All right, next question is, how important is it to have a financial advisor these days? With all the podcasts, the free financial info out there, is it possible to manage your own investments, budget / cash flow, and choose your super provider yourself? Of course, insurances and maybe accessing certain benefits might require an advisor, but is it truly necessary? I mean, first point, appreciate you saying insurance requires an advisor, but go, Gemma.
So I actually love this question. So back to my slide where I have like the 4 options. So obviously, being an advisor, I would hope that at some point in everyone's life that they got comprehensive financial advice. But I also acknowledge that that's not accessible and affordable to majority of Australians. And I don't know if they actually need it. So what I actually love about what Super Fierce does, what I do as a money coach, what Skye Wealth does as an insurance firm, is you can break up the advice that you need at the time that you need it and still get the pieces of your financial puzzle done. Like, gone are the days where you just had to fit into a traditional advice model. So right now, if the super is the most important thing to you, or your budgeting, your cash flow, or your insurance, is you can break up those pieces and get it really cost effectively and the bits that are important to you. And perhaps you are seeking a lot of information from podcasts and your social media and things that puts you in a better position, that when you sit in front of the professional, that you're in a better position to take on the advice, understand it, and then make an informed decision. My only concern with that is how people get information now. Is that before, like years ago, you couldn't get any. It was an advisor or nothing. Whereas now we're bombarded with financial information through social media and things. And it's kind of like, well, who do I actually trust? And how do I know this information is correct? So I think it's a balancing act, and it's you identifying that, yes, you might not need comprehensive advice, but I know what I don't know, and I know when to get the professionals in.
Yeah, and I mean, to that point, like, the business that we run, I run Skye Wealth, so we only do insurance advice. Like, and the reason we actually we went from holistic advice, doing everything for all people and charging a whole bunch of money for it, to insurance advice is because advice these days is very difficult for the average day Australian. So what's a huge high value for me personally and at Skye is that we want to help people protect what matters most by providing affordable and simple insurance advice. So that's kind of what we do at Skye. Is we've decided to give advice in the one area, because it is an area where we can still give affordable advice and provide huge value, but we're not going to solve everyone's issues. And so we're not the right fit for every single person. And so because the reality is not everyone needs a financial advisor today, and they may want to come in and out of getting advice, but definitely for insurance, go to an advisor.
Yeah, and that's Super Fierce exactly as well. Like, they're going, well, we need to help people with super, but we can't do it all cost effectively. So what can we break off and help people with this piece of the puzzle for the people that weren't going to get holistic advice? So I kind of pitch Super Fierce as they were the people that were either going to do nothing, or they were going to read a book and just follow that book. And we've talked about which book that is. So maybe you pay $49 or $100 and you get an actual statement of advice that has holistically thought about that specific issue, but not your whole financial situation. So you're in a really good position right now as consumers of financial advice, that you can break up these areas and focus on what's important to you and not just go down the traditional advice model.
All right, so next question from Facebook. I'm needing to look into TBD and income protection. I have no idea where to start. I'm 23 years old and work as an apprentice mechanical fitter and on locomotives. I've looked at doing it through my super fund and it seems reasonable, but I'm also not sure what is reasonable and what is expensive in regards to this. If you could shed any light on this topic, that would be great. So, really go and speak to a financial advisor. But because it is hard, it is very difficult. Fun fact, it's going to be expensive because you're in a high risk occupation. And so it is going to be difficult to understand. You can go to every super fund and get a quote with them. Sometimes you need to be a member before they'll give you a quote as well, which can make it difficult. But I mean, what we do at Skye, and the reason, like, we show you all our research. We've got nothing to hide. We'll show you all the quote comparisons, what we considered, what we didn't, and we do a lot of that research. And we charge $330 for individuals and $495 for couples to do all that research, because in insurance it is very difficult to do that research. In that super space, it's very difficult. But if you want to look at performance and you want to look at fees and you want to look at like a few other factors, it can be done if you want to go through PDSs, and it's not fun, but it can be done as a DIY. Insurance, and again, maybe because I'm biased, but because underwriting and your medical history, we're all special butterflies, and we've all got our own medical history. Like you said, Gemma, with Alex, like he got declined cover. Now, you were an advisor at the time, so that was, you knew, the ropes. But, a lot of clients that we see that they get declined through their super fund, we can get them covered elsewhere because the insurance provider their super funds with may have tighter rules around certain things. And so, super, I still recommend, speaking of super fierce, and because it's cheap and easy to get to do all the work for you and save yourself a bit of time and headache. But with insurance, the reason we're in business to just do insurance is because of the complexity of it.
Yeah, and my initial thoughts are you ticking the boxes with the fund that performs the best and lowest cost is probably not going to be the fund that offers the lowest cost insurance or the best value for a high risk occupation like a mechanical fitter, right? So chances are, if it's a fund that's low cost and it's performing well, maybe they're really great for safe office workers and stuff, but like a high risk occupation, chances of you nailing, doing your research, picking the fund that then also ticks the boxes for your insurance, that's going to be really, really difficult. So I'd be outsourcing where you can. Get advice from places like Super Fierce, or do your research on where you want your super, but then talking to an advisor and going, I'm young, what policies can I put in place that are going to age well with me that cover my high risk occupation? Because a lot of insurers also don't want to touch stuff like that. So they'll put the premiums through the roof, or they won't offer cover for it. So investing in an advisor, the last thing you want to be doing is paying premiums for something that at claim time you're not getting,
Yeah. And I can tell you, as an apprentice, you're very limited in your options, full stop. As a mechanical fitter on locomotives, you're even more, restricted in who's going to offer you cover, because it's actually going to be pretty difficult to get cover as well. All right, next question. We've got, to protect my retirement savings in super, I'm thinking of getting a second super fund for making contributions for the first home super savings scheme. Do you recommend setting up a second super for this purpose?
So that'd be my question. So regardless if you're saving for retirement or doing the first home super saver scheme, it can be done in the same fund. Absolutely. It's not going to. So when you're doing the first home super saver scheme, it's a terrible name. You're doing extra contributions that are outside the mandatory that your employer has to put in. So it's already contributing more. And then when you actually go to apply to get that money out under that scheme, you have to say which contributions you are allocating to that. So if you were like, oh, well, these are some for retirement and these are some, you can put all that in there. So I don't think you need two funds, but I think if you're going to go down this track and you want to be saving for your deposit, first of all, you need to make sure you're in a good super fund that has low fees, because you don't want to be making extra contributions for your retirement or for your first home and paying extra fees and it being a poor performer or whatever. So the fundamental work that you do before you decide to go into a strategy like that is getting the right super fund, getting the right investments for your retirement, and then making the conscious decision that I'm going to make extra contributions in and allocate them to that. But you definitely don't need a second super fund. I think the only reason you would need more than one super fund is for the example we gave earlier, that one tick the boxes for the insurance, or perhaps you can't get insurance, like the example I gave for Alex. So we kept ticking along, but we didn't actually want his bulk of his retirement money invested there. So we kept one for insurance purposes and one for, but yeah, I don't think necessarily here. I think as long as you've got a good super fund you're comfortable with, you're happy dealing with, they have the investments you want, and the fees are right, it can all be in one place.
Yeah. And like when it comes to superannuation and multiple funds, as long as you've got a clear reason why you're doing what you're doing, then
yeah,
and that reason is sound, then do it. But if
and the biggest misconception is double fees. But for the majority of super funds, you pay a percentage-based fee on what's invested in there. The admin fee is what you double up on, but majority of them is like $70, might be $100. So if that's a strategic reason why you need more than one fund, I would be more than happy to pay $100 a year to keep the insurance I need. You know, that's a fund, that's a fee I'm happy to double up on. But yeah, most of the time, it's not
$70 is a lot of money to some people. So
a year to have insurance I couldn't get elsewhere, I'll pay it.
Yeah, exactly. All right, next question we've got. Is there any point in keeping the same super fund as opposed to using your employers when it comes to insurance? I'm paying much higher premium for insurance by keeping my current super fund as I am now on a personal plan than I would if I changed to my new employer's super fund. Is there any advantages of keeping my current, or is it straightforward to change, whatever fund the employee is using to get lower premiums? So some employers will offer cheaper premiums, or they'll fund the premiums when the super fund's held with them. So, especially if you're working for an insurance company or a bank, they historically used to own insurance companies. They would, if you were with, Westpac and you had the super fund with their super fund, they would fund your premiums. So that you basically wouldn't be paying any premiums. And if you wanted over and above the default, you would pay for that. Some employers have cheaper premiums. It's much less common these days, but it still happens. The only thing I would say is if you're going to move your insurance to your employer's insurance, the concern is, does that contract have a pre-existing health condition exclusion? So some of them will just inbuilt say anything, any health condition before you join this fund, we're not going to cover, we're not going to pay out on. So again, the example is last year you went and got a mental health care plan, you've gone to the new employer this year and you've joined that fund and therefore set up the policy then. And within the actual contract of the insurance provider, it says we're not going to pay out on pre-existing medical conditions. And then 3 years' time, you have a mental health condition that you need to claim on your insurance for. They may decline that claim because they'll say, well, you joined the fund after that condition started, so we're not going to pay out on that. I hope that makes sense. In my head, it makes complete and utter sense. But I hope you're following along. That's the big consideration. Premiums are a massive consideration as well. But it's just there's a whole bunch to consider with that, because the super fund won't actually tell you, big warning signs, we're not going to cover pre-existing health conditions. It's buried in the PDS. So you got to kind of know what you're looking at and reading. Even as advisors, when we look through these PDSs, they're just like a minefield to actually understand what does the contract actually say, and also the fun fact that contract can change, and they can say when they renew that contract with the insurer that they're not covering pre-existing health conditions. So it's kind of
and the thing that scares me about when people go, oh, it's okay, my employer provides this insurance for me, I'll get rid of my other. What concerns me about that is that's fine while you're working for them, but what if in 2 and 3 years you leave that employer and then you have these pre-existing, you've got to go then apply for insurance. So sometimes it's worth keeping your policy, even though you're getting perks of an employer benefit, just because you might not be with them long term and you might not be able to get the same cover that you've had previously. So it's a really strategic conversation you want to have with an advisor. And a lot of people don't know that you can have duplicate policies somewhere like life, TPD and trauma, and you might get paid out on all of them. So the example of Alex, for example, he got paid out on 2 separate trauma policies. Really, income protection's the only one that they'll talk to each other, right, and make sure you're not getting paid more than together. They'll work together and make sure you're not getting paid more than when you were actually working.
Yeah.
You agree, Phil? That's right.
Yeah. It's all a bit. Yeah, income protection is a bit more difficult, but yeah, life and TPD and trauma, generally speaking, unless you got a crazy amount of cover, which almost no one does, they'll all pay out. It doesn't matter what the other company's paying out. Income protection.
Yeah, whereas income protection can be a waste of money if you've got multiple policies more than what your income was. There's no point having them. Whereas the others, if you've got a couple of duplicates, you probably get paid them.
And it's really just about getting educated in understanding it, whether that's through an advisor or doing your own research, and just making an informed decision. So we talk to some clients in that situation. We say, your employer is paying for this, but there's downsides to it. If you leave your employer and, there may not be a continuation option, all of these things that we geek out over. And it's just a matter of saying to people, like, we recommend this because we don't want you paying 2 premiums, or we recommend you this because we think it's, we think it's best for you. But at the end of the day, we'll give you the pros and cons, and we want you to make an informed decision, and you just own that decision and you're comfortable with it. And so it's just about making sure you understand it, all the pros and cons, and then move forward with whichever decision you make.
Yeah.
Right. Next question. Contemplating switching from regular super fund to an actively managed fund. Interested in any recent experience, do's or don'ts, or things to watch out for?
Okay, so this one will be me. So to be honest, well, we've talked about this before. The super fund itself is the administrator. Within the super fund that you're with, there'll be different investment options on their menu. Think of it like that. That can be index, actively managed. They can be Australian shares, overseas shares. There's going to be lots of different things that you can do. So a lot of the time, if you're not happy with the investment option you're in with the super fund, it might not actually mean you change super funds. It might mean that you look for something else within that fund, or absolutely, if they can't tick all the boxes, you go somewhere else. But I think what you need to weigh up here when you're looking at how you invest within your super, because you have so much control over that, is what level of risk am I comfortable with? So how much risky assets, so your growth assets like shares and things, am I comfortable with having in the portfolio? How much safety do I want in it? What fees am I prepared to pay? So they're the types of things you want to consider, but it's not necessarily about moving a super fund. It might be, well, you're with the super fund that you're comfortable with, where your insurance is or whatever, but perhaps the investment allocation that you're in within that fund no longer suits your needs and you want to change it around. I personally am with Super Fierce. We're very much on the same page that index investing, just following the market, paying lower fees is a great way to keep money with you, whereas actively managed, in this example, you generally pay more for, and you're hoping that the guy in the office, the investment fund manager, is making decisions that are going to increase your returns. But yeah, it's totally up to you. But I don't think if you're in an investment that you're not happy with, it might not mean changing super funds. It might mean doing a little change within that actual fund.
Yeah. Guy or girl, you meant to say, Gemma?
Oh, so yeah. Sorry, guy or
not
girl.
Just the guy
anyone
in the office. All right, next question.
Anyone.
I am 28 years old. You are from Queensland. We forgive all bad comments from Queenslanders.
I call everyone guys. Sorry.
I'm 28 years old. I like to think I'm pretty financially savvy, investing in property, shares, and myself, but I cannot get my stuff together when it comes to superannuation. It's been in the too hard basket for most of my adult life. I avoid opening letters from my fund, almost missed a crucial letter telling me I had to update my account details. Where do I start? I'm still with the same super fund as when I first started part-time job. I'll answer this, Gemma. The answer is go to Super Fierce. I get like super's complex, annoying, too hard basket. I get letters, statements, don't know how to read it. Just go to Super Fierce, pay the.
It's $49.95 at the moment.
I'm going to show my privilege and say pay the cheap, reasonable fee, and get it sorted out, and just understand where you are today, because you'll get a statement of advice. So it's an advice document saying this is where I am today, and this is where Superfears recommend I move my super money to, or the investment allocation within my current super fund. And at least you, even if you don't do anything off the back of it, at least you know, oh, this is kind of where I should go, or this is kind of what I should be doing. And then you should action it and take action. But get educated, make an informed decision, and then own it. Don't put things in the too hard basket. Superfears is a service offering that is incredibly cheap. The reason why we like working with Superfears is because we believe it fills a massive need for a lot of our clients who they want help with the insurance side of it. But we don't give superannuation advice. We're not going to tell you to move super fund or roll over anywhere else. And so they help with that. And it's just about, pull your finger out, just get it done once and for all. And then moving forward, you know where you are, you know why you're there. And then those letters won't be so, daunting. For $50, just that mental frustration of getting the letter and go, oh, too hard, you get reminded by it. For $50, just go and do it.
Yeah, that's exactly right. Couldn't have said it better myself.
Can super funds be inherited by beneficiaries upon account holders passing? Over to you, Gemma.
Yeah. Okay, so your superannuation, lots of people don't understand, but it's not actually an asset held in your name. So even if you have a will, it's not the same as in your will putting my car goes to whoever, my house goes to whoever. So if you don't have a beneficiary on your superannuation, the trustee of the fund, just like when we're talking about your best interest of the insurance, the trustee of your fund will look at all your family members and whoever's eligible and go, oh, who's in the best interest? Who are we doing, best interest for our member, which is you who's passed? Where should this money go? And they will actually work that out for you. But you've got a couple of options. You can actually put a beneficiary on your superannuation. So you can do a binding nomination, which think of it as ironclad, going to the super fund, do this is my wish. Or you can do a non-binding, which means, hey, this is my suggestion. If you agree with it, please pay this person. So they're your two main options when you're notifying the super fund of who to pay as a beneficiary. But there's another layer to that not everybody can be a beneficiary of your super. So they have to tick a couple of boxes. So they have to be a spouse, a financial dependent, a child, or someone in a inter-financial dependent relationship. So when you're considering how your super fits into your estate planning, I would always recommend you speak to an estate planning lawyer and say, hey, I got a house, I got a car, let's do my will, but also let's talk about who I list on my super or how that works with it. Because, if you've got a will, super won't automatically come into play with it. And who you list as a beneficiary has tax implications as well. So, for example, if you had adult children who were non-dependents, they're grown up, they're 30, they'll pay tax on your super, whereas a dependent child, under 18 or whatever, won't pay tax. A spouse won't.
Or your spouse, yeah.
Yeah, there's so many considerations there, but this is one thing like insurance that you don't want to get wrong because you can't fix it once you're dead. So get an estate planning lawyer, get your will sorted, ask them what you should be doing with your super as well. They'll tell you which nomination and who's best to list. But it's not something you can fix if you've done it wrong. So
you're dead, so you can't fix it anyway.
You can't fix it. But one of the biggest misconceptions is if you don't have a beneficiary, it goes to the government. It doesn't. The super fund just does more work. The trustees just do more work trying to find who has claim over it and who should have some of it. And they might decide that it's someone that wasn't in your wishes. So getting it right the first time is the most important thing, and updating it, because generally you need to update this every couple of years with your super fund.
All right, next question. Can Superfears help with advice about contributions to super?
We don't currently do that. We do have a full advice license, but right now we're just trying to nail investment and product. So what I actually recommend when people want to do contributions, if you go on the Superfears website, you'll go through a free retirement planner, seeing if you're on track for the amount of money that you need for your ideal lifestyle. And if that falls short, we're still going to recommend a super fund and an investment allocation for you. Majority of those super funds that get recommended then have what's called intra-fund financial advice, which I talked about earlier. They're not going to say a super fund's better for you, but we've told you that's the best for you. So once you're in with them, I would say utilize that free financial advice service. When I say free, it's not free because you're paying member fees, right? So utilize it and get help with your contributions.
And some funds may quote you, may charge you for it. Not all funds have intra-fund.
Yes. Some will. I'm just thinking of the majority that come up that meet our requirements for low fees, high performance, and the things that we do. Most of them have intra-fund advice. You wouldn't ever go to them and say, hey, which super fund's best for me? Because they're not going to do that, right? But if you've come to SuperFierce and we've told you which super fund to go into, the next thing then I'd use their service. Or you can jump on places like Money Smart, right, and work out for my salary, which is the most effective way for me to put into super. So lots of avenues, but getting the right fund first is the absolute first step. Don't put money into a super fund and do contributions if you're just paying a lot of fees, right, and getting underperformance.
Yeah, I'm going to completely butcher the business and offend many people at SuperFierce, but comparing fees and performance and all of those very specific things and plugging in the balance is very easy for a computer to do.
Yeah.
Determining how much contribution you on an individual level should make or not make is very personal, because two people in the exact same, two sets of data for individuals with the exact same data set may have very different needs long term. So it is a bit more difficult for a computer to nail that service, and that's why you guys don't do it today.
Yeah, and it's gonna be hard. We'll hopefully get there one day. But there's so many different contributions that you can do, or a combination of them, that means that you'll get better tax benefits or better kickbacks, like a co-contribution. So get in the right super fund and then look at contributions.
Yeah. All right. Second last question is, it was mentioned claiming on insurance within super can be difficult. Just out of curiosity, how insurance benefits are taxed, any differences between insurance within super versus retail insurance? If so, which is better? All right, I'll touch on that. So in terms of the taxes, so it's with regards to like life insurance, it's going to be taxed very similar, unless there are a few complexities. Like Gemma said, the insurance is paid to the super fund if it's owned through the super fund, and then paid out according to superannuation legislation. And there's some, tax differences if you've got an adult child and whatever. Life insurance outside of super is taxed potentially different, but the main one is disability insurance. So disability insurance is taxed if it's claimed inside of super and paid to the super fund, then pulled out of the super fund. It is taxed at a complex rate that's not super simple. A lot of advisors go, oh, let's do 22%. That's actually not 22%. It's based on the date in which you started putting money into super, and it's based on how far away from retirement you are. So the closer to retirement up until a certain age, you pay much more tax than you are younger. So it is pretty complex. I won't go into the actual math of it all, but it's just got a specific formula based on tax and untaxed, and I won't go into details. But TPD payments that are paid outside of super. So, I mean, actually, Gemma, I'll put that over to you. Did Alex pay tax on it, or because he was drawing an income?
Yeah, so yes, usually as an advisor, I would always have a strategy to gross up the amount. So if you needed X amount of TPD, we would gross it up to allow for tax. But the most important thing here is the takeouts are you need advice on what insurance you need, but also if you're going to go through a claim, you need advice on how the most tax effective way to get that money out or to claim on that money. So for example, so in Alex's case, yes, he got a lump sum into two super funds. If he had just taken that out, he would have paid quite a lot of tax on it. And that's what most people do. They go, oh, this money's in super, I'm happy to pay the tax, I want it out for my mortgage. But there's strategies that you can do. You can turn it into an income stream and draw income payments rather than lump sums, or a combination of both. Sorry, I've got a visitor. So there's lots of ways that you can do things. So the most important thing is, if you're looking to get money out, no matter how you got paid that claim, talking to an advisor. So Alex and I, when we were married, opted to not actually take any of his payment out of super as a lump sum, even though we had a mortgage, because our mortgage was like 2% back then. And we kind of went, well, let's leave it in super because it's invested. Let's just draw out the minimum we want because that was tax effective. But that strategy will totally change. And that's the beauty of having a solid financial strategy, that it can adapt. So, you know, it might be that this year he goes, well, it's not worth me paying X amount on my home loan. I might take it out and pay the tax.
Correct.
But right now he has options. So I think if you're going to get insurance, get advice on the structure. And if you're going to get a payout, get advice on which is the best way to do this. And it might not be the most straightforward way. It might be really, really strategic. And it means that you keep more money with you and more options open.
Yeah, that's right. And just to circle back around, TBD paid outside of super, that's structured, that's owned outside of super, there is no tax on it as well. So there are pros and cons of, you know, the way to structure it. And but yeah, we gross up when we do a calculation. We gross up for the potential tax, and we use the actual math on how it's taxed. So 2 questions. We've got 1 minute. Let's quickly punch out these 2 questions. If I have insurances within super and retail insurance, can I claim on both, or are there some cases where I can only claim on one? We answered that before. So you can claim generally on the lump sum on both insurers. Income protection gets a bit more difficult, whereby some of the default covers within super, they actually won't allow any income protection payment if you're receiving any income somewhere else. A lot of super funds, so there are some super funds who will say, as long as your maximum payment wasn't over 75% of your pre-disability earnings, then you can get paid multiple on income protection. But generally speaking, lump sum is a yes. Income protection, bit more complicated. Last question. If I decide to have insurance within super and retail insurance, what risk should I look out for? Oh, that is a much longer answer.
We don't have time.
We don't have time for it because the little one's coming in and needs Gemma. I got to go to the snow. Great question. I'll try and answer that sometime in the future because there are many pros and cons. But if you need to reach out,
I think that's value advice, right? Like the advisor's going to sit down and go, right, let's put this one in superannuation because it's the low risk one. Let's put this outside because it's your best chance and claim. And they're going to do like a little potion of what's your best outcome. So that answer is you need advice because it's going to be different for everyone.
A little potion. I like that. We're like alchemists here in advice land. So if you need to reach out to Superfierce, here's the QR code. I'm going to assume it works. Fantastic. Use that. Do you love this webinar? Please say yes, because my ego can't handle any other answer. But we're doing one in September the 26th. So use that QR code. We're doing a Life Insurance 101, everything you need to know about insurance. And we love feedback. If you loved it, if you didn't like this webinar at all, my ego can bad reviews. So honest feedback, we love to make these as good as we can. So before we finish up, well, now I'm finishing up, I just want to big shout out and say thank you so much, Gemma, for joining us and running through. That was really informative. I didn't get through all of my questions because we ran out of time. So thank you very much.
You can grill me another day.
Yeah. Thank you everyone for coming as well.
Thanks for having me.
All right.